Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Today we will discuss about deposit mobilization. The functions of deposits in the economy. By studying this chapter, you should be able to explain the concept, credit creation, and its rules in the economy, identify different categories of deposit types and structures, critically analyze relationship of deposit, investment, and consumption, synthesize the deposit functions, economic expansions, and wealth creation. How deposit in financial institution and its rules in the economy. You should be able to understand the importance of deposits to financial institutions and how they function in credit creation process, economic expansion, and wealth creation. Deposit is also interrelated to other important economic variables such as investment and consumption. This relationship will be discussed to enable you to integrate the different elements related to deposit and its rules in the financial and economic system. Deposits are defined as funds placed in a financial institution by economic surplus units such as households, corporations, investors, and governments. These funds can either be from cash, claims to money, like check placed in deposits account, bank loans, or money from investment. Financial institutions such as commercial banks, merchant banks, financial companies, and discount houses are granted license by the central bank to accept deposits from their customers. These institutions are called deposit-taking institutions. Other financial institutions that do not comply with the definition in the Act are non-deposit taking institutions and hence are prohibited from taking deposits from the public. Examples of non-deposit taking financial institutions are factoring or leasing companies. By depositing money in a bank, the customers expect the bank to safeguard their savings, to utilize them into productive investment for a satisfactory rate of return, or to enable them to facilitate their payment transaction. At minimum, a customer expects that he gets back a dollar that he puts in a bank, and the bank has a contractual obligation to honor the claim on demand or upon withdrawal. To a bank, either operating conventional banking or Islamic banking, deposit is its main source of funding for which it uses to produce income. Some literature has cited that deposits contribute 75% of a bank's total fund. Banks use customers' deposits mainly to give out loans to deposit economic units or borrowers. Besides loans, banks also mobilize deposits by purchasing trading securities, investment, and maintain some as cash in hand to meet withdrawals on demand. The larger the amount of deposits a bank receives from its customers, the better its capacity to give out loans and the higher is the interest income. Because of the positive relationship between deposits, loans, and interest income, banks are competing intensively and aggressively among others deposit-taking institutions to obtain higher deposits by offering attractive deposit rates or rates plus other appealing package depositors. Islamic banks are equally aggressive in attracting additional deposit. To the economy, bank deposit is the main source of money supply that can be mobilized to generate economic growth and wealth creation. By giving out loans to borrowers and investors, banks create credit. Banks' ability to create credit enables them to supply money to borrowers, suppliers, and investors to conduct economic activities, such as opening up plants, funding the working capital requirements, financing their business expansion, or increasing their investments. Such economic activities create job opportunities, increasing productivity and income, which subsequently lead to wealth creation in the economy. For interest-bearing deposits, interest rate is very important. When market interest rates rise, so will deposit rates, and this would attract higher deposit to flow into the economic system. In the philosophy of Islamic finance, money is required to be mobilized in productive investment. There should not be idle money. Whoever holds idle cash or demand deposit exceeding the nisab over a year must pay zakat. According to Saiful Azhar, this is one way how Islam discourages people to hold idle cash from an indefinite time. Deposits are equally important to Islamic banks as a source of funds as in conventional banks. But unlike its counterpart, Islamic banks need to comply to Sharia principles which prohibit any payment of interest or a fixed return on deposit. To attract idle cash or deposit from the public for sustaining their financial activities and wealth creation, Islamic banks are offering deposits whose returns are based on wadi'ah, mudorobah, or qardul hasan. The mudorobah, or a profit loss sharing basis of Islamic banking, is conceived as more productive oriented and growth promoting than its interest based counterpart. Further, the placement of interest with profit loss sharing principle is also said to increase investment opportunities in the economy. Looking from both conventional banking and Islamic banking perspective, deposits are important to generate economic growth and wealth creation. Concept and theories on deposit. Concept. Three main concepts of deposit are deposits as a source of fund, as liabilities of banks, and the return from deposit mobilization. Source of fund. A bank has three sources of fund, namely bank capital, bank reserve or retained earning, and deposit. Among the three sources, deposit from the main component of a bank's source of funds. The basic concept is that deposits are the foundation upon which banks thrive and grow. They provide the most raw material for bank loans and other investments from which a bank derives its main source of interest income. Despite increasing its diversification toward fee-based income from projects and financial advisory services, banks are relying greatly on interest-bearing deposits and assets to generate interest income and profit. Hence, banks compete aggressively to source more deposits from its customers, which can be governments, suppliers, corporations, investors, or households. Deposit is also as an integral source of funds for Islamic bank. However, unlike conventional bank, an Islamic bank cannot use its deposit to make profit. This is because under Sharia principles, one cannot trade on non-commodity item and money is treated as a non-commodity item. Under this concept, deposits are prohibited to be lent out with a purpose to make or to maximize profit. Sharia permits only if deposits are lent out to ease the burden of the needy ones, for promoting economic activities, and for the wealth of the society. Islam upholds the belief that the returns of good deeds one does today will be repaid not only today but also in the world hereafter. Liability. Traditionally, a bank borrows or utilizes a large proportion, approximately 80% of its customers' deposit, to give loans to borrowers. A bank deposit then are the amounts that is owed to its customer. Hence, deposits are the principal liability of banks. The significance of this conduct is that in the event that the bank is liquidated, the depositor has a first claim on the proceeds of sales of the bank asset. A specified amount for the deposit is allocated to meet the statutory reserve requirement ratio (SRR) imposed by the central bank. By definition, SRR is the percentage of deposits that commercial banks must maintain as required reserve in a central bank. This item is recorded as statutory deposit with central banks in the asset side of the balance sheet of commercial bank. For many countries, SRR ratio is sometimes used as monetary tool to control money supply in the economic system. The ratio varies between countries. For Malaysia, SRR is currently set at 4%. Besides SRR, a commercial bank may utilize the remaining amount of deposit to purchase interest-bearing short-term money market instruments, which are termed as trading securities, and for investments, stock, shares, and medium to long-term securities. A simplified version of the bank balance sheet and T account is shown here to illustrate deposit and bank operation. Suppose Bank A has a paid-up capital of 3 million and reserve of 10 million. The bank equity total to 30 million. Assuming Bank A customers deposit 100 into their current accounts, the bank put the 100 in its vault and add 100 in the customer current account. The 100 deposit will show up as a liability, while the 100 million deposit in the bank vault will show up as asset on the bank's balance sheet. The 100 million asset can be in the form of cash, loans, statutory deposit, and investment. Okay. Similar to financial banking, deposit of Islamic bank is a liability. The concept of deposit as borrowing in Islamic banking started during the leadership of Zubair al-Awwal. Al-Zubair treated the money entrusted to his father for safekeeping as borrowing. Under this concept, he was able to use the money for economic purposes. The deposit becomes safe first since as a borrower Azubert argued that he is responsible to pay back the money to the owner. The change in the concept of deposit from trust or wadiah to borrowing consequently enabled the people to use the money to operate business based on the principles of kirot or mudarabah as well as to share the profit from the business. Similar to conventional bank, not 100% of the deposit amount is lent out to borrower. An Islamic bank is still subjected to SRR ratio, but the percentage of deposit is 4% for conventional banking. The remaining amount is utilized to purchase liquid asset and investment and Islamic trading securities. Return. The third concept related to deposit is return. For consenting to mobilize their deposit, depositors are rewarded with a predetermined rate of return by conventional bank. The rate of return depends on the type of deposit, the deposit amount, the length of the maturity periods, and the bank's cost of fund. In conventional banking, market interest rate is very instrumental in determining the deposit rate. The concept of return for depositor in Islamic banking is different from conventional banking. Based on Sharia principle, riba or interest is prohibited and a predetermined fixed rate or a guaranteed return on investment is strictly not acceptable. Al-Quran states that which you give as interest to increase the people's wealth increase not with God, but that which you give in charity seeking the goodwill of God multiplies manifold. Surah Ar-Rum, verse 39. The underlying thrust in prohibiting a fixed or guaranteed return on deposit is that there is an existence of an element of uncertainties in any project or investment venture financed by the bank from mobilization of its customer depositors. The prohibition is based on the arguments of social justice, equality, and property rights. It is argued that there is justice if profits are determined exposed because it shows successful business venture and creation of business wealth. On the other hand, return is determined ex ante in the form of predetermined interest. Is a cause that is accrued, respectively whether the business venture is profitable or a loss. In the event of a loss, this may not create wealth at all. In terms of equality, Islam demands that borrowers and lenders share rewards equally and that there should be a fair distribution of the wealth created in the economy. The profit and loss sharing basis is a basis of return where the bank shares business risk with the borrower in the return for shares in the profit of the bank's venture. It is based on mudarabah and musyarakah principles. Profit and loss sharing concept is a unique feature of Islamic banking and is increasingly getting popular among investors, especially in times of economic uncertainties. In addition to the profit-loss basis, there are other modes of return or rewards payable to depositor depending on the type of deposit account he has with the Islamic bank. Table 2 shows the types of account and principle used to compute rate to depositor. Okay. This is account type. principal applied, current account based on the principal Qardul Hasan or Wadi'ah, saving account based on Wadi'ah, Mudharabah or Qardul Hasan, investment account based on predetermined shares of profit, Islamic negotiable certificate of deposit based on the principle of Mudharabah or Qardul Hasan. Theories. Several theories and principles are explained in this section to provide better understanding of deposits and their role in wealth creation and distribution in the economy. Financial intermediation theory. The theory of financial intermediation describes four economic functions of deposit-taking financial institutions. First, financial intermediation. Second, information specialized. Third, delegated monitor. And fourth, payment and financial services provider. Black and Beston and Smith explain that banks as financial intermediaries are in a position to obtain confidential information while assessing loan application and access privileged information both on the demand and supply side of the market. With this information, banks are able to match financial needs of capital surplus units, those with excess funds, and capital deficit units, those that require funds locally and globally. To capital surplus units, banks offer convenient financial service in order to contract deposits from them and then loaning those funds to capital deficit units. These intermediation activities take place if there exists a positive spread between the expected yield on the loan given to borrower and the expected interest rate cost to be paid to the depositors. In the context of delegated monitor theory, depositors have delegated the role of safekeeping their savings to their bankers as well as entrusting them to invest their savings prudently for better returns. Thus, banks have the fiduciary relationship with their client to ensure no depreciation in deposit value or losses through bank staff negligence or excessive risk-taking. They are also being entrusted with keeping depositors' and borrowers' accounts strictly confidential as financial information is costly. In another context, banks are also being delegated to assess information correctly and sufficiently to arrive at sound investment and loan decisions. In this case, after loan disbursement, depositors expect banks to act as their agent to monitor the loan's account and financial positions of the borrower in order to ensure smooth loan repayments and interest income generation. It is therefore important that banks execute their delegated monitoring function honestly, effectively, and efficiently so that shareholders' wealth is maximized. Information asymmetry. The ability of banks to monitor their borrowers' conduct and creditworthiness depend greatly on the extent of information available. Some information is not made accessible to bankers while others have. This uneven distribution of information, known as information asymmetry, sometimes leads banks to making poor credit decisions resulting in large non-performing loans. In cases where banks have inside information, they are in a better position to choose financial instruments with better risk-return features. This provides them with greater opportunity to give better returns to their depositors. Diversification theory. Diversification theory postulates that a well-diversified portfolio can reduce risk. Diversification can be in the form of asset or geographic location. Accordingly, if a bank can diversify its loan portfolio by giving loans to many borrowers, that is observing the single customer limit guideline of the Bank Negara Malaysia, or disburse the loan into several sectors and or in many geographical locations, the lending bank can reduce its risk exposure, resulting in increased safety for its depositor. On the other hand, banks are taking risks by their willingness to accept risky loans while issuing low-risk securities to its depositor. To compensate them for borrowing the risks such as credit risk or the probability of loan default, banks build in the risk premium in their loan pricing. If a certain loan is perceived to be very risky, the lending bank will build in higher risk premium, resulting in higher interest rate charged to the borrower. The concept of diversification theory is also applied to bank deposit. A bank diversifies its deposit base by maintaining many types of deposits such as saving deposits, current or demand deposits, fixed deposit or investment deposit in each banking, while saving and demand deposit allow customers to draw many at any time. Fixed deposit or investment deposit have certain maturity period 3, 6, 9 or 12 months. A bank discourages customers to withdraw their money before the maturity period because the money has been invested or locked in a certain investment. If there is a need for early withdrawal, the customer has to give prior notice to the bank, otherwise they have to pay a penalty fee. Such diversification reduces a bank's liquidity risk, that is the risk of not having sufficient funds to meet customer immediate claims. Okay, this is the session 1. We will continue to session 2.